The sell-off may not be over. After 3 weeks of losses and a decline of more than 1% yesterday, U.S. stocks have more room to drop. That's the word from Tobias Levkovich, chief U.S. equity strategist at Citigroup. He's here with us on the Inside Track. So, Tobias, more room to drop. How far?
In our sense, it would be more of a run-of-the-mill correction, 5-7% type of thing. I don't expect something to be down 10, 15, 20.
So we might not
like that.
Test that recent intraday low of 1249.
I'm not a technician who spent a lot of time trying to figure that out.
No, but that's whatever, 9%.
Yeah, I mean, it could happen, sure. We had that back in April timeframes. That wouldn't be unusual. Are we looking at a new bear market? Are we looking at a real collapse economically? The answer is probably not, for a variety of reasons, including credit conditions continue to be very favorable, and that's generally been a good 9-month lead indicator on economic activity.
So the optimists say, oh, valuations have come down. We've got a hot market for IPOs, including a couple of high-profile internet names, looking for excuses to want to call the market higher, and we see a little bit of upside this morning. Why are you fairly certain that we are in the middle of this 5 to 7% correction? What are the downward pressures on stocks?
Good question, and I think we were trying to outline this already back in April, that there were probably about 5 or 6 things that were coalescing as we were moving into the summer months, and they ranged from margin trends starting to come under pressure, something we saw come in really last September based on our lead indicators. We were looking at the debt ceiling issues. We were looking at the factors related to quantitative easing ending. We were looking at the fact that earnings expectations for the second half are probably a bit too high relative to current likely trends. On
European
top of that,
sovereign debt, too.
Well, sovereign debt as well. I mean, our global chief economist, William Boyder, was talking about Greece being a problem already by the summertime. And we were also looking at things like the seasonal factors to economic cyclical conditions. And normally we start to see a weakening in things like the leading indicators going into the summer months, and that people would probably excessively interpret that.
But a debt ceiling disaster, a default by Greece, maybe something worse for Portugal or Ireland, severe margin pressure, not to mention the unknowns to follow QE2. Any one of those things, it seems, on its own, could drive a 5% correction. So given the fact that they continue to proceed, the Spanish, right, rejecting austerity, we really don't know what that's going to mean for European sovereign debt, and more concerns about Greece. The debt ceiling situation isn't getting better, and it getting any better. So how do you know that they aren't going to coalesce into something worse?
We don't. In all reality, I think the differences are the things that are positive against that happening into something much more disastrous.
And what are those underlying positives?
One, credit conditions, as I indicated before. If you look at the Federal Reserve Board's lending standard survey for loan officers, this is on commercial industrial loan activity, a great 9-month lead indicator. This is what told us back in 2008 that we were looking at something much more severe. Did not tell us in 2010 during the summer when everybody was worried about double dips that something would be wrong. It usually leads to job growth, capital spending, GDP, industrial production.
This is the real stuff. This isn't just quantitative easing finding its way into stock valuations. This is real lending contributing to real...
Well, it's lending conditions, and I think we need to make that distinction. Lending activity actually lags the lending conditions by 18 months. So if you're just looking at the cost of capital, which is the way investors think or should think about return on invested capital relative to cost of capital, businesses make decisions on what their cost of capital are. And right now it's very attractive for them to make investment decisions. Junk bond yields below 7% make even risky investments make a lot of sense. Now, that's a very strong positive. The other ones would be lots of cash looking for something to do. For example, pension funds, and I'm talking about defined benefit programs, are sitting at 25-year highs in bond investments and 25-year lows in terms of the allocation to equities. If you're trying to make an 8% return for your pension holders, really hard to do when you're buying 4% bond yields unless you're praying for deflation.
So with those positives in place and maybe those trends accelerating, how come you're not more optimistic about the prospects for the S&P 500 this year? If I'm not mistaken, your target is about 1,400, right?
Right.
Are you expecting that that's going to start to translate into higher stock prices next year?
Well, I think it'll happen later in the year as we get through kind of the adjustment here through the summer, particularly on second half expectations. But more importantly, I think people, if you want to be very bearish, you say valuations are a problem, margins are going to collapse, which isn't our view. Margins will come under some pressure, but not collapse. Similar, if you want to be particularly bullish, you say, well, multiples will expand because we're trading 13 times earnings on a 3% bond yield.
But you're not as bullish as the bottom-up consensus is.
Well, we're not terribly under those numbers, but it's more about will multiples expand, and we think not in an environment where we have some fiscal adjustments that'll have to happen the next couple of years. You know, if you want to kind of think about it very simply, you say let's say we get normalized on the economy. We finally get durable, sustainable recovery where bond yields aren't going to stay at 3.1% on the 10-year. They're going to move up to somewhere in the mid-5s. And if you say we're not going to fix our fiscal house, then at some point in time, next couple of years, you're talking about a higher bond yield to fund growing debt. So almost irrespective of your view, you're going to have an outcome with higher bond yields, and that's the problem with multiple expansion. The market's already anticipating some issues related to higher cost of debt.
So right now is a risk-off attitude the right one?
From a trading perspective, yes. I mean, am I a buyer of the market down 4%, which feels like it's down 40, the way people are reacting to it? Yeah, but you know, there's probably still some more downsides, so why rush in right this minute?
Right. Wait to see it play out first and then maybe come in. Tobias, always good to have you here in the Inside Track. Please come back soon. Tobias Levkovich, Chief U.S. Equity Strategist at Citigroup. You heard him say there he expects the correction to continue, but to be limited to a drop of 5 to 7%. And his target for the S&P 500 remains 1,400 for the end of 2011.